Does it matter if you put retirement savings in the older spouse's accounts first? Does Marion have a good VTSAX to VTWAX tax loss harvesting and portfolio rebalancing strategy? Those are the main topics today on Your Money, Your Wealth. Plus, Joe and Big Al help you make sense of fees, both from your financial advisor and on exchange-traded funds, or ETFs. Big Al will provide pointers on selecting a good certified public accountant, other than him, of course. And finally, do 457 plans ever blow up? Go to yourmoneyyourwealth.com and click Ask Joe and Al on air to send in your money questions. I'm producer Andy Last, and here are the hosts of Your Money, Your Wealth, Joe Anderson, CFP, and Big Al Clopine, CPA.
Alan, we got Jeremy. He writes in, he's a supply chain manager. I don't know why. I guess this is a new requirement that we're asking now what their occupation is. Is that what you're doing, Andy?
No, that one was just volunteered to us by Jeremy.
He's from Cookeville, Tennessee. So, supply chain manager. I don't know what a supply chain manager does. Manages the supply chain. Wonder what type of...
Yeah, that's exactly right.
See,
you make sure you get your widgets.
Very smart today.
Essential supplies, I'm sure.
Watch out. Andy, Joe, and Big Al, thanks for all you do educating your audience. I sincerely appreciate the ability to explain complex concepts in a way it's easy to understand. I also appreciate the occasional derails and comic relief. It's a good balance. I've learned a lot in a short amount of time, thanks to your podcast. Most notably, I didn't know until hearing it on your show that I can withdraw from my 401k without penalty starting at age 55 if I separate from the company that offers the 401k plan during that 4.5-year window prior to 59.5. This is a big deal since he plans to retire a little early. So 55, separate from service at age 55. You have full access to a 401k plan. As long as you don't roll the 401k plan to an IRA, then you have to wait till 59.5. So, yeah. So he's got a question, Al.
Yeah. Well, and before we do, let's be clear on that, because if you have a 401k, an old 401k from another employer, that doesn't qualify for this special rule. It's only your existing 401k with your existing employer. If you retire after age 55, then you can withdraw the money. Of course, you will pay taxes on it, but you won't pay the 10% penalty.
So my question today is related to retirement savings for my wife and me. I'm 42, wife's 35. We invest 15% of our income into retirement accounts, 12% into my 401k, and the other 3% in a Roth that is in my name. So nothing for the wife here, Al. Totally.
No.
Just, it's all him. Jeremy, the supply chain man. He's managing the supply of his retirement account
yes,
in the family household. It sounds like he's taking work home with him.
Apparently there's money in supply chaining.
He's killing the game. We do not save any money into accounts for my wife because she's 7 years younger. And so we feel that we would have to wait an extra 7 years to be able to access the money without penalty. I'd be 66 when she turns 59.5, and I believe that we would want to start drawing down earlier than that, potentially as early as when we're eligible for withdrawal of my 401k at 55. Well, she would be eligible too, Jeremy, at 55. It's not only supply chain managers get this rule. You know what I mean?
That's right.
So if she saved money into her 401k plan, and if she separated from service at her age 55, you're still good to go. We plan to invest into accounts for her until we max out the 401k and Roth accounts, but we're only about halfway there, so still room to run. My wife works, but our company does not offer any kind of matching program for the retirement. I should also mention that my wife is named as the beneficiary. Wow. What a nice guy. Wow. Well, thank you. Wow. I'm sure she's thank you.
That's novel.
Yeah, it's very, yes.
Your wife is beneficiary.
It's crazy.
That's really
sweet. I think this is the first time I've ever heard that.
I mean, I could feel the romance from here if we're doing that. That's awesome.
Even though by law, the wife has to. be the beneficiary. She has to sign off on it, Jeremy. Oh,
yeah,
boy.
right.
So
if you want to do something other than.
All right. Well, I don't know. I guess for the lack of equality, I mean, if there's not, he's 42, right? And he's looking at, all right, well, we're going to retire at 55. So he's got a 10, 12 year time frame, 13 years, something like that. Supply chain manager, saving 12%. First off, I mean, to retire at age 55, depending on what Jeremy's spending, he might need to save more than the 12%. So he's going to have his wife save a little bit of cash into her 401k plan. So the first step I would do is kind of do a forecast this way, is saying, here's how much money that I'm spending. Let's say Jeremy spends, I don't know, $60,000 a year. Where does he live?
Cookeville,
Tennessee. I don't know. Him and the wife, maybe 75 grand. Cookeville, that's a pretty nice place. And then you look at, hey, I want to retire in 15 years. So you take your $75,000 living expense, and then you use some inflation factor, maybe 3% from age 42 to age 55, and see what that $75,000 comes out to. Let's just assume it's $100,000, right? I'm guessing. I don't have a calculator in front of me. So if he wants to spend the same lifestyle in retirement at age 55, and he has $100,000 that he's normally spending, well, he's going to need a few $1 million in his overall retirement account to provide that type of lifestyle, especially if you're trying to bridge the gap from 55 to age, let's say 67 to his full retirement age, where he's going to receive Social Security benefits. So that's a 12-year gap where he's going to have to produce 100% of the income. So that's the starting point to say, am I on track? Am I even saving enough? So is 12% enough? Is it 15? Is it 20%? Is he have to max out his plan and the wife's plan, God forbid? And then so she's going to have to name him as beneficiary. Can you believe that? I bet there's going to be some dinner time conversation.
Yeah, she may or may not. She may pick another person. But yeah, I think that's good advice, because
it's not advice. It's conversation.
Okay, that's good conversation, right? You're right.
Good suggestion.
A suggestion. At any rate, I mean, that's always the first step, right? Is when you figure out if you want to retire at age 55, you got to work backwards and do a little math and figure out, are you on track to do that? And assuming that they are, although I would agree, saving 12 to 15, I guess 15% total, that's a good number, Joe, but it may not be enough to retire 10 years earlier than other people, if people retire at age 65. So you just have to figure out whether they're on track for that. But I'm going to take this maybe a little different direction in terms of, if you only have so much money to invest in retirement accounts, should you favor the spouse that's older, right? And I think that's not necessarily a bad idea, because the spouse that's older will have access to those funds penalty-free earlier, right? So probably in this case, they're going to want to both save. I agree, to be able for Jeremy to retire at age 55. But if you only have so much money, you might want to kind of favor that spouse that's a little bit older, particularly because his wife doesn't have matching in her retirement account.
Right. But you want to look too at, all right, well, what does a 401k look like? What fund choices do they have? What are the fees? What are the expense ratios? Things like that. Roth accounts, however, though, they have full access to that money at any point, of the contributions anyway, prior to 59 and a half. So if you do want to retire early, folks, and you can even retire at 50, you have full access to Roth IRA contributions. There is no penalties or taxes on the contributions if you choose to take them out. We would probably suggest not to do that. But that is a way to get penalty-free cash if you're in a pinch. So interesting question, but we appreciate it. Thanks a lot from Cookeville, Tennessee. Just keep managing those supply chains, Jeremy. Appreciate it. How about Marion?
Who's now signing them Clovis/Fresno.
Clovis/Fresno.
Well, they're right together.
Marion. All right. Hi, Andy, Big Al, and Joe. Is this a reasonable strategy or too complicated? Each year, create a taxable event by selling my VTSAX mutual fund shares that have a long-term capital gain. This amount is taxed at 15%. My tax bracket is 22%. When there is a major downturn in the market, then sell my VTSAX mutual fund and buy VTWAX, a substantial different mutual fund, thus creating a tax loss to offset my ordinary income in the 22% tax bracket. No, it's not too complicated, but let's talk about Al, what she's doing here. So let's say, forget about the timing aspect. You know, when the market goes down and the market goes up and this and that, don't try to time it. Just put bands on it, right? It's called rebalancing or tax loss harvesting is what she's actually referring to, which can be complex. But if you hold a mutual fund at $10 a share and it goes down to $7 a share, and you sell that mutual fund and you buy something similar, right? It can't be identical. It needs to be different, but it could be somewhat similar. So then she creates a tax loss of $3 per share. So that tax loss then will carry over until there's a gain during that year. If there is no gain, then she can offset ordinary income up to $3,000. So that's kind of the premise of harvesting losses, is that you can continue to harvest losses because those losses will offset gains into if there is no gains, then you can write off against ordinary income up to $3,000.
Yeah, and then the rest of your loss carries over to the next tax year and the following year after that and the following year after that.
So, but her question is, each year create a taxable event by selling her mutual fund shares that have long-term capital gains. So she's going to go, all right, I'm going to sell a mutual fund that has long-term capital gain. So then I have a capital gain, right? This amount is taxed at 15%. Yes. So any capital gain is taxed at 15% or 0 or 20%, depending on what tax bracket they're in. Marion is in the 22% tax bracket. So when there is a major downturn in the market, sell my fund, buy another one, and thus creating a tax loss to offset my ordinary income. So there's a little confusion because
right.
if you sell at a tax gain, right? So that's a capital gain. The tax loss will offset the capital gain dollar for dollar for how much loss or gain that you have. If you have more loss than gain, you will offset the gain, but then any additional will offset ordinary income to a cap of $3,000. If she has it, or he is Marion a boy or a girl? We don't even know.
We do this all the time. Marion is female.
Okay. Marion, let's say, has $100,000 loss and has a $50,000 gain. That would be offset dollar for dollar, right? So if she had a $50,000 gain, $100,000 loss, there is no tax on the gain. Right? Because she had $100,000 loss, there'd be a $50,000 loss carryover. But she can't write all $50,000 against ordinary income. Only $3,000 of the 50 would be offset ordinary income. And then $47,000 would carry over the following year, depending on if she had any other capital gains or not. If she had more capital gains, she could offset it with her loss. If there was no gains in her brokerage account, she would then take an additional $3,000 off ordinary income. So it seems that she's kind of getting confused in regards to ordinary income, what's offset, what's not. So capital loss versus capital gain, anything more than that will be carried over for until she uses it. And yeah, Al's.
I think we just lost Al.
Yeah, I don't know.
Oh, he's back.
Can you hear me now?
Yes.
I can hear you now.
Yeah, you guys froze. The part I heard, Joe, sounded right.
Yep, perfect.
We continued on. You froze on us.
Yeah, okay. I think the main concept, and people get confused about all this all the time. They think they're going to sell their stocks and use that against their salary, or use it against a Roth conversion, or use that against some other ordinary income, and you can't. You can only offset against capital gains, and then if you still have more losses than gains, you get to take $3,000 against ordinary income, and then you carry over the rest to next year, which I know you said, Joe, but that was right on.
Click the link in the description of today's episode in your podcast app to visit the podcast show notes at yourmoneyyourwealth.com and learn more about rebalancing and tax loss harvesting. I've posted some blog and video resources, including the YMYW TV episode, Don't Let the Tax Man Ruin Your Retirement. You can also download 8 Timeless Principles of Investing for free and read the final installment of Brian Perry's blog series, Decision 2020, Your Vote and Your Money, on how to election-proof your portfolio. You may remember that Brian Perry, CFP, CFA, is the Executive Vice President and Director of Research here at Pure Financial Advisors. All of that stuff is in the podcast show notes at yourmoneyyourwealth.com, and it's all courtesy of Pure Financial. No thanks necessary, but if you really want to say thanks, the best way is to share the YMYW podcast and all the free resources so that others can laugh and learn too.
Hello, Joel. Thank you for that.
In parentheses, Joe.
Yeah. Big Al and Andy. Marcus here from Tennessee, Alabama. Well, Marcus, it's been a while since you've chatted. Roll Tide. Great show as always. Keep up the excellent work. Below are my questions. To keep it short, I'll send another email a week later. Can't promise that one will be short. Please discuss how expense ratios on ETFs are paid. ETFs, an exchange-traded fund, is referring to, Alan.
Yes.
Can you calculate the average portfolio expense ratio by taking the average of the ETF expense ratios inside a portfolio? If someone has an actively managed portfolio with an advisor that uses a 1.14 AUM model, and this portfolio has an average expense ratio of 1.03, then is this person paying 2.17% in fees? I'm trying to get clarity on one of my mom's accounts. When asked about fees, her advisor said, your total program fee for this account is 1.14%. But I see these expensive ETFs in there as well. I could simply ask him the question since he's the advisor, but where in the fund would that be? Thanks again. All right. So a couple things. When you're looking at fees, there's multiple fees that an individual pays if they're working with an advisor or not. So an exchange traded fund, there's different flavors of ETFs. 1.03% expense ratio on exchange traded fund portfolios seems fairly high to me. If they're just following an overall index, that those fees should be like 0.03%, not 1.03%, because there's very little, right? 0.03%, 0.003%.
And maybe they're actively managed ETFs, right? That could account for a higher expense ratio.
Yeah, and I've seen some of that as well, where you look at an exchange traded fund. The difference between an exchange traded fund and, let's say, an index fund, there's very little differences. It's just like how you're purchasing them and how they're constructed. There's some nuances there. Because mutual funds, you have one price, where an exchange traded fund, you buy it like a stock. So it kind of, depending on the price of the day. And so anyway, I don't even know why I went there, but the fees on exchange traded funds are very, very low in most cases. So I would want to make sure that that if they're charging 1.03% in exchange traded funds, then you need to make sure that you're looking at what types of funds these are, and tell your advisor, why am I paying 1.03% in exchange traded funds when I should be paying 0.03%? The advisor fee of 1.1%, 1.14%, that's very standard within the industry. But I'm not sure why they're selecting some of these ETFs unless they're like leveraged. And if it's your mom's account, that sounds off to me. But yes, your math is correct. 2.17% in fees is what the total fee is for the portfolio. But the expense ratio for the exchange traded fund portfolio just seems a smidge high.
Yeah, that's right. The math is right, but there's actually even yet another fee, which is turnover, right? So the fund's turnover, in other words, how often the securities inside the fund are sold, is going to impact the cost as well. And that's something that's harder to figure out, right? And usually, let's say a 1%, 100% turnover is like a 1% additional charge right there, right? So in other words, if all the stocks are getting turned over the course of the year, you might have another percent on top of this 2.17. So you got to look at that too.
Yeah, you would want to go to the statement of additional information. So you get the prospectus, of course, that we all read. And then you have to ask for another document to really see the true fees. So that's the statement of additional information. But then there's also buy and sells. Right. So So if they're buying and selling the exchange traded funds, this could be a wrap account. And so they're saying, well, no, the total fee is 1.14%. So you're not paying for any of the trading costs. We'll bear those costs versus if it's not, you got the 1.14% plus the expense ratios plus any type of trading costs that happen within the portfolio. So understanding fees is important, but I would look at, are you sure she's in exchange traded funds? If she's in average mutual funds or actively managed mutual funds versus exchange traded funds, because there's not that many actively managed ETFs. In the actively managed ETFs are based on like algorithms, so they're still following an index, and sometimes the company itself will create their own index. And so they'll say, hey, we want to tilt this overall ETF more towards companies that have low price to book ratios or something like that. And then, or they're more value orientated, or they're more growth, or they're more small, or they're micro. Hey, we're only going to focus on healthcare. So, but they're still buying a basket of stocks. They're not actively trading. The algorithm is on the purchase. So it just seems high. Anyway, I don't know. Anything else to add there?
No, I agree with that. It does seem high. So yeah, check into it.
All right. So we got a question. There's Packer Backer Mike. Hi, Big Al. I love your show. Those other two who joined you, Johnny and Amy, can listen to my question if they'd like. Look at Packer Backer Mike. What a
right.
He
did that just to get you. Yeah, that'll work.
I've been a DIY for my finances and taxes all my life. I guarantee Packer Backer Mike has got 60 grand. He's a DIY and he's like 73 years old. He's probably made $200,000 for the last 20 years. He's a spender. Let's see, I forgot where I was. I plan to retire sometime in the next 2 years and would like a transition to a CPA who can not only prepare taxes, but assist with some tax planning. What should I look for in a personal CPA? What questions should I ask? Love the show. Packer Backer Mike.
And the irreverence that comes along with it. Because irreverence is too long.
It's too long.
You didn't want to say that.
And I didn't want to fumble. Go Pack Go. So he knows I'm from Minnesota, so that's why he's saying that, because I'm a Minnesota Viking fan. Go ahead, Al. Help Packer.
All right. Packer Backer Mike. So you want a CPA. So I guess the first thing, you probably ask around for some recommendations from your friends, or if you don't have anyone that knows a CPA, maybe go to Yelp. But a lot of CPAs don't get reviewed. A lot of professionals don't really get reviewed on that. So it's kind of, if you can, it's kind of best to ask for some recommendations from people that maybe 2 or 3. When you start calling them up, ask them things like, well, first of all, what do they charge? I mean, that's very important. But in terms of getting a quality job from a CPA with tax planning, I guess just ask them how long they've been in business, what kind of clients they have. Are their clients similar to what your situation? Like if you're a business owner or real estate owner, is that the kind of thing that they do? find out if they do tax planning. Ask them, do you do tax planning? And then if they say yes, ask them, what does that mean? What kind of services can you expect at year end? Are they doing tax projections, or are they just sending you a year-end tax planning newsletter and you have to kind of do it yourself? So I don't think there's any magical questions here other than just, getting to know them, find out, does their experience seem to be relevant to what your situation is? Is the cost reasonable? Have they been in business for a while? So that's how I'd approach it.
Alan, when you had your CPA practice, what was what client would you rather have? A small business owner client or just a personal 1040?
Yeah. When I had my practice, Joe, I would say a small business owner was kind of my forte.
Because you could charge more.
Well, and that plus I did a lot of business returns, so I got good at that. And when there's business returns, there's more complex tax planning, which I enjoyed, right? Because there's interplay between the business and the personal return. So I ended up with a lot of just straight individual returns. I mean, you normally do as well. But I liked business owners. I further specialized into high-tech companies, particularly software companies. I specialize in
I don't want your own resume. I'm just saying, Packer Backer Mike here. I'm just giving him I've never been a CPA. I never had a practice, and right. So, but if I'm looking at, let's say, the financial advisory space, is that advisors want to work with people that have millions of dollars because they can charge their fee and they get more compensation for the work. But if you have a smaller client, but then is asking for different things, maybe CPAs don't necessarily want to go down that path. So I could see why he's looking for, all right, well, what do you specialize in? I'm looking to retire. I want some ongoing tax strategy in regards to my retirement plan, cash flows, and things like that. Do you do that? I would say most CPAs on an individual basis don't do that type of planning. The CPAs out there that I've seen will do the planning for the businesses. They'll have the bookkeeping. They'll have that type of forecasting. But do you disagree?
No, I agree. But the hard part is that they'll say they do it.
Exactly.
That's why you have to probe a little bit more. What does that mean to do the tax planning?
Right. I mean, most advisors say they do tax planning. And
right.
They don't.
And they don't.
You only have a few days left to get your free copy of the brand new book, Ignore the Hype, Financial Strategies Beyond the Media-Driven Mayhem. Written by our EVP and Director of Research at Pure Financial, Brian Perry, CFP, CFA. Ignore the Hype will teach you how to keep your focus squarely on time-tested strategies for meeting your financial goals without getting distracted by a constant barrage of news headlines. There might be some of those today. Learn the difference between short-term trading and long-term investing, how to filter out the constant onslaught of information coming your way from every angle and separate the valuable content from the noise, and how to build a foundation for investment success based on common sense and academic research. Stock is limited and it's only available on a first-come, first-served basis, so click the special offer button at yourmoneyyourwealth.com right now to request your copy. If the special offer doesn't say Ignore the Hype, you waited too long and we sold out. Click special offer now at yourmoneyyourwealth.com.
Matthew writes in from Wisconsin, Alan, and he writes, Dear Joe-Lady.
Joaldi.
And that is called a what again?
Now I can't say it. An amalgamation.
Amalgamation.
He came up with this amalgamation of all three of our names.
Because he run in before, Al. And then he's like, somewhere, he goes, I can pretty much guarantee that you've never heard of where I live. It's in the middle of nowhere, Wisconsin, so who cares? And then I came up with the name Lake Wannabagosh, because I believe that's where Matthew really lives, but it's a very beautiful place.
I'm sure.
Yeah. So thought it might as well be Joe's amalgamation of Wisconsin cities.
Amalgamation.
Amalgamation. I think we need a new rule for the show. If it has more than like a couple syllables.
Yeah, forget about it.
Conversion is 3.
Well, amalgamation. I've never heard of these words. Al, do you use amalgamation in your vocabulary often?
No, very seldom.
Got it.
Have you ever used it in your teeth, Joe?
There goes Al's mic.
I got so excited I dropped my mic. Well, he's doing an amalgamation is a combination. That's probably an easier way to say it, of our three names.
Yes.
So we got Joe, we got Al, and D for Andy.
Yes. Do I go to the dentist? Is that what you asked me?
I said, do you have fillings in your teeth? Those are amalgams.
No, I've never had a cavity. Thank you very much.
Wow, I'm impressed.
Yep. So anyway, thank you, Matthew, for this total sidetrack here. Thanks for discussing my previous question about trying to convert some pre-tax retirement assets into Roth without leaving my job. The CRD angle is interesting, but unfortunately or fortunately, we can't justify it. So been looking for some other paths to take tax-free assets. All right. So he has access to a 457 plan at a mid-sized nonprofit healthcare organization where I work. As often as I've drooled over the thought of it, I've avoided contributing, being non-governmental, is subject to creditors and ineligible for a rollover. The organization currently has a good credit rating and is growing, but if these funds depend on its solvency over the next 30 years, that seems a pretty significant risk to me. So we'll circle back to the 457 plan here. But since changing our 403b contributions to 100% Roth last year, our MAGI has increased to very near or over the limit for direct Roth IRA contributions. I'm not intimidated by the back door. Wow, that's aggressive. And have no other IRAs, but we've already made the contributions during the downturn. So I've been contributing to my 457 plans to keep our modified adjusted gross income below the limit to avoid penalty or recharacterization. So the question, in your vast and priceless experience, have you seen these plans actually blow up? We're already maxing out all of the other available retirement vehicles, HSA, contributing to a brokerage and have cash to spare. I know it's theoretical possible, but I just can't determine real world how the risk plays. Thanks again for gutting out some of these questions. I hope this one's easy on the ears. I look forward to hearing your discussion as I ride around in my 1985 Craftsman.
I don't even know what that is.
I would say that's a motorcycle.
Ah.
Yes, or it's a lawnmower.
Probably.
That could be.
One of the two.
Probably a really, really cool lawnmower, right?
Yes, right. No, I would have to look at the plan a little bit more, of course, but in general, we highly recommend 457 plans. So if you're a school teacher, if you work for hospitals and things like that, a lot of nonprofits have both a 403b and a 457 plan. The 457 plan, you have access to several different mutual funds within the overall plan. And in most cases, I've never seen a 457 plan that you have access to. I would have to look at, who's the custodian on this thing. But yes, you could roll that into an IRA after separate from service. Going back to Jeremy's question, if you had a 457 plan, you have access to the money at any point. There is no 10% penalties in 457 plans. So have I actually seen a 457 plan blown up? The answer is no. So I wouldn't be too afraid of it. But I'm not speaking on his 457 plan because I have no idea what it is.
And by the way, Craftsman is a riding mower.
All right.
Oh, there you go. Okay, perfect. Yeah, at 457 plan, the money goes into a separate plan, so it's independent of the entity, right? So if something happens to the entity, the plan's still there.
So, yeah, go for it, brother. Go for it. And then it goes, P.S. Joe, I was going to send you some spotted cow like you suggested, but since you don't technically give advice, I didn't feel all that compelled. I guess you need some reason to visit. Well, thanks a lot. Send me the spotted cow, because that is the best beer that you'll ever taste. All right. Spotted cow did not pay me for that.
Joe's going to tell you all about his fake tooth today in the derails. Your Money, Your Wealth is presented by Pure Financial Advisors. Click the Get an Assessment button in the podcast show notes at yourmoneyyourwealth.com or call 888-994-6257 for your free financial assessment. Pure Financial Advisors is a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full and informed investment decision.
I do have a one fake
never
tooth.
Been to the dentist.
No,
Right.
I go to the dentist.
Never.
I go twice a year. twice a year.
There you go.
You do.
Yeah, I do have a fake tooth though, right in the front, so I have a crown or a
Oh.
bridge. A bridge. It's a bridge.
A bridge.
Did,
Okay.
did
Yeah.
somebody knock out your original tooth? What happened?
Yes, I knocked it out like 5 times. Actually.
Oh, wow.
Yeah, first time was roller skating, and I was doing, the chain, and I must have been in like 6th grade. It was like right behind this really cute girl. It was loving life. It was really cool. Then I tried to skate backwards, and then the bumper blew up, and then I chipped my tooth, and then I did it sledding. Then I did it playing football, playing basketball. I never wanted to get a flip or like I should have did a, what's it called?
An implant?
Yeah, implant. Thank you, Alan.
Yeah.
But I didn't
You
because
still can, can't you?
no, because
Yeah,
I grinded down other teeth. I would have to get 3 implants.
Got it.
Because I didn't want to take out the front tooth because you go on dates and then you got to eat and you can't have the little flipper, so you take it out. I don't care how good looking you are. If you don't have a front tooth, you look like something out of. Anyway,
plus you can't talk right.
yeah. No, you know the drill.
I recently.
Got it.